US Federal Reserve has issued a volley of dovish signals around rate cuts, though Wall Street was expecting more of a hawkish message from the US Fed chair. The US Fed Chair Powell has kept the Fed fund rate at 5.25% to 5.50%, the highest in the last 22 years. Inflation has eased from a peak level of 7.1% in 2021 to 2.1% in March 2024. The Fed has hiked the interest rate almost 11 times ever from its zero levels. Despite substantial moderation in inflation from peak levels, the progress in taming inflation has not been satisfactory. The post-meeting commentary from Jerome Powell indicates the same. Powell said inflation was still too high and any decision on rate cut would be taken only after greater confidence is achieved on the progress on the inflation front, as the target is to bring inflation down under 2%. The personal consumption expenditure, a key gauge for the US Fed to determine rate cuts, stands at 2.8%, which strips out food and fuel. So, will there be a rate cut or not? Not indicating any timeline for the rate cut to begin, Powell has indicated that inflation is just a bump in the road rather than taking the Fed to a different route. According to him, the inflation has just delayed the rate cuts, but rate cuts eventually will come. Earlier, when the US Fed had its last meeting, the DOT plot showed the possibility of 3 rate cuts in 2024, but persistently stubborn inflation dashed the hope of rate cuts and also pushed the rate cuts to the end of this year. Some are even going to the extent of saying that there will be no rate cuts this year, but bets are about a probable rate cut around September. So, is the US economy headed for stagflation?